Hey everyone, Richard Norris here, and welcome to today's video all about latent gains. So one of the main things I want to talk about today is what are latent gains? This is a question that I get asked by my clients a lot. Now, for those of you who don't know who I am, for those of you who are new to my channel, my name is Richard Norris. I've successfully built a multi-million pound property portfolio. And one of the things that we've helped our clients with over the last 5 years is helping them to understand incorporation of a privately owned property rental business. Now, kind of the first thing I want you to know is, and for disclaimer, I'm not a tax consultant, I'm not a chartered accountant. I do own an accounting practice. We work with chartered accountants inside our training program under the brand propertyconsultant.io, and we have specialist tax consultants where we outsource the work to for specialist tax planning for any of our clients who are thinking about incorporation and where their property portfolio, their privately owned property portfolio in their personal name is rife for incorporation. So the first thing I just want to explain to you, like I said, just to really get this out of the way and kind of address the formality. I'm not a tax consultant, I'm not a chartered accountant, but what I'm sharing with you today is I'm imparting my wisdom upon you from the last 5 years of working, like I said, with thousands of clients who have come through to our training program and our services and have worked with ourselves where, like I said, rightfully outsource the work to the specialist people who can help them incorporate their property portfolios. And like I say, the biggest problem that I see when I kind of look at this work and kind of raise the awareness of our clients is that they just don't understand what a latent gain is. They're not sure what it is, they're not sure how they've created the latent gain, and it's something that their accountant has never, ever made them aware of. And so they kind of get themselves into this big tax liability problem that really didn't need to be there. So I'm really excited to kind of share this with you today and to go through the key points. What is a latent gain? How does a latent gain occur? I'm going to explain to you and go through a client case study so that you can see effectively how bad this latent gain can get. If you exacerbate a latent gain, the numbers can look really quite horrific, and you can have hundreds of thousands of pounds of a tax liability, which obviously nobody wants. And if there's a way to kind of soften that blow, then that's always a good thing if you have the knowledge and the tools and the wisdom and the skill set to be able to overcome those problems. So that's my aim and purpose and intention of today's videos, is to raise your awareness about latent gains, talk to you about why the problems occur, how we can solve those problems, what options you have, and to go through a client case study with you as well to give you some full insights into some of the work that I do and some of the works that we undertake within the propertyconsultant.io brand. So with that being said, and without further ado, let's jump in. So if you're new to this video today and you haven't watched my previous video, which is called Interest Rates and the Buy-to-Let Property Market, an analysis of the current market, where I talk about the huge arrangement fees that are being added to low interest rate mortgages at the moment, I would go and check that out after watching this video. Or you can stop this video, go and check that out now and then come back to this video, whatever you think's best. But effectively, the arrangement fees that are being added to loans exacerbate this latent gain problem. So that's why I've kind of suggested you watch that video, because they kind of go hand in hand, okay? And I'm creating some bite-sized videos all about property tax and mortgage interest rates at the moment, because they go hand in hand, like I said, and there are lots of crossovers and synergy between the two. So if you see me looking to the left, by the way, today, it's because I've done all of the calculations to prepare for this video. On the screen here, I'm going to get my team to go in and put all the calculations up. So it'll be like a digital whiteboard, and I'm using the screen in front of me here as my whiteboard. So let's talk about what a latent gain is. Well, the true definition of a latent gain is this. A latent gain occurs when the equity in your business is less than your capital gains. And by definition, capital gains are current value minus acquisition costs, and equity by definition is current value minus liabilities. So to substantiate that, then let's do our first set of numbers. So let's say that the property value that we have is £500,000. The mortgage liability on the property is £375,000, and therefore the equity is the difference between the £500,000, the property value, and the mortgage liability of £375,000, which gives you an equity position in that one property of £125,000. So by definition and by calculation, that's what equity means. Next thing then, let's move on to capital gains. So capital gains is, by definition, as we said, current value minus acquisition costs. So let's say we purchased a property for £200,000. The acquisition costs, which were stamp duty, land tax, legals, broker fees, and any capital costs that we've paid, could be £20,000, which means that the total acquisition costs are £220,000 in this example, okay? Now let's say that this property that we bought for £200,000 over the last 15 years is now worth £500,000, right? And Therefore, the current value is 500. So our current value is 500,000 minus our acquisition cost, which is 220,000 pounds, gives us a capital gains value of 280,000 pounds. Now, the latent gain calculation obviously is we take the capital gain, 280,000 pounds, we minus off the equity of 125,000 pounds, and we have a latent gain of 155,000 pounds in that example, because the equity in the business, you can see there, the equity is 125,000 and the capital gain is 280,000 pounds, so the equity is less than the capital gain by 155,000 pounds. So that's one way to look at what a latent gain is by formality. Now, whenever you're incorporating a property rental business, you have to look at your base cost. So there's a base cost calculation that we do. And to explain this, I'm going to explain why we do the base cost calculation, why it's important in attributing what the true latent gain is, and the implications on transfer and incorporation of the properties. And effectively, I'm going to talk about how you create that situation in the first place, because that's the biggest thing. If I can teach you how you create a latent gain, you're not going to create the latent gain in the first place, which is obviously going to be beneficial. But our clients don't have this information before, so they do this stuff. Then they come to work with us and we're like, why did you do X, Y, and Z? Which I'm going to talk about in the video in a second. And it's just because they had a lack of knowledge and understanding. So what is a base cost calculation? Well, your base cost calculation is effectively the summation of your purchase price, your acquisition costs, and your capital costs. So in this example, the acquisition costs are going to be your stamp duty, land tax, your legals, and any broker fees that you paid. And then we'll talk about capital costs in a second. So let's say that we purchased this property. So purchase price was £200,000. That's our purchase price. Our acquisition costs on this purchase, we're going to say that you paid 3% stamp duty. You're a buy-to-let property investor, so you've got the 3% surcharge. So the stamp duty on this property is £6,000. You spent £2,000 on legals and conveyancing to buy the property, and maybe had a broker's fee of £500 that you paid to the broker to go and find a mortgage for you. Okay, and therefore on this particular scenario, then our purchase price 200,000 plus the stamp duty, land tax of 6,000 plus the legals of 2,000 plus the broker fee of £500 gives us a sum of £208,500 as a base cost. Now, let me talk to you about capital cost. What is a capital cost? A capital cost is effectively anything that you've done to the property that significantly added the value to that property. The easiest way to break down a capital cost is, have you done a loft conversion or have you done an extension? Something that's materially added value to that property, okay? So things like refurbishment, such as painting, decorating, new carpets, new flooring, things like that, they're not a capital cost. They're what you call a revenue cost and can be offset against your profit and loss statement for the year for that accounting period. We're specifically only talking about capital costs when we do a base cost calculation. For the purpose of this example, I've said that we haven't done any capital cost improvements to the property, and therefore it's zero. So we've got a base cost of £208,500, right? And when we bought this property, we took out a 75% loan to value mortgage. So remember, we purchased the property for 200,000. 75% loan to value mortgage meant that the mortgage that we took out was £150,000 on day one. Now, what I'm suggesting is that in 5 years' time, you come and refinance the property, okay? So you bought this property for £200,000 and you've experienced great capital growth of £100,000 over 5 years. So the property is now worth £300,000. That's the new value of the property, okay? And what you did at year 5 is you took the £300,000 and you took a mortgage out at 75% against the 300, and you decided to refinance the equity out of the property by paying back the original mortgage of day one, which was £150,000. So you've got your new mortgage, £225,000, 75% of the £300,000, minus the original mortgage on day one, which was £150,000 from the previous calculation, if you remember, gives you an equity release of £75,000. Now remember, we're talking about that this is a property that you own in your personal name. It's a privately owned property. Now, what you do in this example is you have a situation where at the point of incorporation, because that £75,000 was not put, we're assuming that it was not put back into the base cost. So you didn't take that £75,000 and buy another property, in which case the £75,000 would go into the base cost calculation. You took that £75,000 and you've done something else with it, right? And I'm going to explain what you might have done. So maybe you took that £75,000 and rather than putting it back in and buying another property and adding it to your base cost, so you wouldn't create a latent gain, you maybe took that £75,000 out to go and buy a property in your own personal name to live in. So effectively you use your equity from your buy-to-let property to then go and put down as a deposit on another mortgage, which is your own occupier mortgage, your own home that you live in. You've now moved that away from the base cost of the balance sheet on your privately owned property rental business in that example. Other things that we see people do is they release this £75,000 equity and they pay that as income. And that's one way that people say, well, you don't have to pay income tax. It's one way you can get around Section 24 finance restrictions. There are some other property mentors, if you like, or for whatever you want to call them, talking about, hey, one of the ways to get around Section 24 finance restrictions is to keep putting loans on the property, keep refinancing the properties over the years and using that loan as income to yourself so you don't pay any income tax, and it's a way to get around the Section 24 if you're a high rate taxpayer. I personally don't agree with that for the reasons that I'm explaining in this video, where you're all of the time exacerbating and creating a massive latent gain in the portfolio. So what we prefer to do is, only if it's right, is to incorporate the property into a company or incorporate the properties into a company, doing it in the right way. Not every situation can you incorporate the properties. First and foremost, you must understand that, and you must get subjective tax advice and legal advice to make sure that you can incorporate. Now, assuming that you can incorporate, in this example, you've either took that 75,000, moved it into your own home, or you've took 75,000, used it as income. Either way, you've taken out the base cost, or you used the 75,000 and maybe you gave it to John, Dave and Zoe, your kids. For whatever reason, you decided to give it to them early and gift it under the 7-year rule of inheritance tax. You want to mitigate inheritance tax exposure. That's another classic example and a classic mistake that we see people make. Or they use the money, honestly, just as a liability to fund their lifestyle or whatever, or pay for car payments or buy a car, right? So you've moved it out where the base cost is the material conclusion of what you've done. That's how you've created this tax liability. And in doing so, what you've done is you've got £208,500 as a base cost. And because we took out the mortgage on the 300,000 at 75% to release that equity, we've now got a mortgage liability on that property of £225,000. So if we take the £208,500 base cost, we minus off the mortgage liability of £225,000, that means on incorporation, we've actually got a £16,500 latent gain, and that will trigger a capital gains tax bill at 28% of that value if you're a high rate taxpayer and 18% of that value if you're a low rate taxpayer. Most of the clients that I work with in my quantum property program are high net worth individuals, are people who are just higher rate taxpayers or additional rate taxpayers. So for the purpose of this video, I'm going to talk about 28% of that number. So you take the £16,500 latent gain, your base costs are £16,500 less than the mortgage liability, which means that you crystallise at 28% on £16,500 is a £4,620 capital gains tax bill. Now, that doesn't sound too hideous. Yes, you've made a mistake. You've created a latent gain that didn't need to be there. If you took that £75,000 and reinvested it back into another property to add to the portfolio in your privately owned name, then you would effectively have put that back into your base cost, so you wouldn't have created the latent gain. But you didn't do that. You made the mistake, and it's cost you just under £5,000 in taxes that you didn't need to pay. So that's how that kind of works in the example. Now, what I want to do now is say, well, maybe that doesn't sound that hideous, and you might be looking at this video and thinking, right, I understand what a latent gain is, Rich, and thank you very much for sharing that with me. That doesn't seem like a massive problem. And if it was just at that level on one property, it wouldn't be a huge problem. But the problem is when you compound the same problem. And I'm working with clients sometimes that have anywhere between 10 to 30, 40, 50. Actually, our biggest client had 144 properties prior to incorporation. And when you're making mistakes like this and you compound the same thing a number of times, all the way up until 144 times, your tax bill becomes enormous and you create this huge latent gain. And it's important to note, when you have the knowledge and the wisdom, you don't create those problems and you don't make those mistakes in the first place. So whilst just on one property it might seem minimal and trivial, over a big portfolio for incorporation and anything from 10 plus properties, you can see that your capital gains tax bills on the latent gain for incorporation gets quite large. So what I want to do now, I'm going to hop over to my computer and I'm going to share with you the dashboard of one of my clients, which I we've just worked with, and we're currently going through the process of understanding whether my client can incorporate their property portfolio. They've had all their tax consultations with specialist tax consultants, chartered accountants and lawyers, and they've been told, yes, we believe that you can incorporate under Section 162, apply for business incorporation relief because they're a partnership business. So this specific example, before I go into show you the dashboard and all the calculations and where their kind of tax bill has come from and how they created that latent gain and just how big this can get and how the problem can manifest itself, is the husband and wife got 11 properties that are owned in their personal names. They're jointly owned properties, and they've been buying properties for a number of years, 15 years or more together. So that is now qualifies as a partnership business. They manage all of the properties themselves. They can easily substantiate 20 working hours a week to the management of their portfolio. They work full-time on the property business. They don't have any other job. So they've got a property portfolio privately owned between two people that should have been a partnership business. Now, they actually had set up partnership business accounts. They'd put it into an LLP, and they'd done that before working with ourselves, and they're looking to incorporate. But the biggest problem that they have, which I'm just about to show you, is that they've actually created a latent gain on the property portfolio over a number of years of making the wrong moves and making the classic mistakes that we see, that we help our clients to rectify when they come to see us. So I'm going to hop over in there now. I'm going to go through everything with you, and I'm going to give you a real life example of a client case study that I'm working on right now. Okay, so over in the client's dashboard here then, so let me start off by giving you a brief summary of it. So this client had 12 properties that were jointly owned between husband and wife. For the purpose of the recording, for the purpose of keeping my client's details private and confidential, I've taken out the property addresses. We put all the property addresses down here. 12 properties owned, like I say, in joint names, and a couple owned in personal names, but largely owned in joint names and personal names. And that's kind of the situation. This spreadsheet that we use encapsulates all of like the property types, the number of beds and everything, whether it's freehold or leasehold, number of years when they purchased it, who the lender was, mortgage terms, etc. Is it a fixed rate, variable rate? When they remortgaged it, is it interest only or capital interest, or unencumbered properties, for example? What is the type? What is the use class? HMO flats, service accommodation, commercial. Who's managing the properties? What's the fee that they're paying? Is it owner or agent? And then the fee. And then we put in like all of the values, purchase price to work out the total capital gain in the portfolio, what the outstanding mortgage balance is, the loan to values, and then we get the equity positions, and then we take their rents and we take off all of their costs per month, and then we turn that into an annual profit at the end. So that's kind of like a really high level overview of how this all works. Some of the nuances that the client faced. The first one is that because this is only their private personal name, effectively they have an inheritance tax bill. So between husband and wife, you have a nil rate allowance of £325,000 each, and an additional top-up of allowance, £175,000, that can be used against your own home. So for the purpose of this, you have like £1 million as a collective entity, of which the £1 million has already been used up on their own home anyway under the nil rate allowance. So you get 325 in your personal name plus 175 for your own home. So the additional is only on your own home. So it gives you a combination of, like I say, 500 per person, which is £1 million between the two. So they've already using their nil rate £1 million allowance on their own home. Therefore, in the property portfolio, they don't have any allowance left. So they're paying 40% tax on the total equity position here, which came to 40% of the £4,686,225 of equity that sat in the portfolio, meant that they had an inheritance tax liability of £1,874,490. So you can see, if you're not buying things in the right structure, and you've been doing this for a number of years, these guys purchased their properties back in 1995. I'll show you that in a second. You can compound these problems. And although the video is going to be talking about latent gains, I just wanted to share some information and insights into how problems can compound, because I'm going to show you that latent gain in a second and how that compounded over time. Based on the video, we had one property, if you remember, at the start of this video, and the latent gain was only £16,500 on one property. When you've got 12 properties all with latent gains, you'll see the effect of that. So it's really important that you understand that you're just compounding your problems. The longer you don't address your issues, the bigger your problem becomes, right? And the harder it is to solve. And it's just costly, and also time is money. So you're better off, if you have these problems, just addressing it and getting them fixed immediately, sooner rather than later. And so, yeah, these guys had purchased properties back since 1995, and they came to work with me in 2023, so last year. So effectively, they've been building the property portfolio for, the best part of like nearly 30 years, right? So, 28 years to be exact is how long they've been building this in the wrong structure. So they're already set up as a partnership business now, and they were looking to incorporate. Now, if you look up over here, like one of the things that we track is we track the base costs. So the purpose of this, we're going to go through the latent gains. So we put everything into a dashboard and we kind of track all the analytics. This is a system that I created, and I work with my quantum clients on this exact system. And in our first consultation, we kind of go through everything and do all the analytics together. And then we, like I said, we refer them on to the relevant tax professionals and the accountants and the legal team to give them the advice that they need. My job in the process is just to consult with them as a property investor, show them how to piece the whole thing together. Because the biggest problem that you face is, like, if you're somebody who's got this problem, you think, oh, I'll just go to the tax consultant or a chartered accountant just to incorporate my properties. That's all very well and good if that's literally the only thing you want to solve. But most people, when we ask them the question, is like, what do you want to do after you've solved the problem? They're like, well, I want to optimize the portfolio, I want to grow it. So if you're trying to grow your portfolio and restructuring as part of that, then you're better off doing two things in once. Because if you just take the tax kind of premise and just look at the tax, you're missing half of the puzzle. You can't make like a tax decision off of just all past data. You need to be thinking about the future. The best tax advisor will tell you that, hey, all of our tax work is based on future projections as well. So it's important that we kind of marry up the two sides. Otherwise, it's kind of like completing the puzzle with only half the piece and then coming back to try and do it later. Again, foundations are wrong, and you can't build a house on sand. And most people are building their property portfolios on sand, just to be brutally honest and candid about that. So in terms of the latent gain, we have our base cost, right? So our base cost is the summation of the purchase price, which is £2,335,320 for this client. It's the summation of their purchase costs, okay, which is stamp duty, land tax, legals, valuation, and broker fees. This is left blank because in this situation, we decided to put all of the capital costs in one lump sum. And then we have their capital costs. So what have they spent on capital costs? Adding value to the property, either extensions, loft conversions, etc. And then the capital costs inclusive of their purchase cost brings the capital cost here. So they had a total capital cost of £1,160,845. So if you add up these numbers, you get a base cost of £3,496,165. The problem is, though, look what happened. Their mortgage liability across the portfolio is £3,863,774, which meant that they had a latent gain of £367,609. The difference between the capital base cost and the mortgages is £367,609. So they had crystallized a 28% capital gains tax bill on this number. Would have been £102,000 up on incorporation due for capital gains tax bill that didn't need to be there. So in this client situation, one of the things that they can do is, because they're quite lucky over here that they've got all of this equity in the property, they can either sell the property or release some of this capital to then pay, because out of this £1 million of equity, they just need to tap into 367,000 to basically reduce the mortgage balance down to £3,496,165, so that their base costs and their mortgages, as we talked about in the video, are nil. Right? And therefore you kind of solve that problem. Then what they can do after incorporation is refinance the assets and pay back this debt over here to where it came from. Whether they sell the house or whether they refinance the property is up to them. So that's kind of like one of the things that you can do, and just giving you an example of what happened in the situation. Overleaf, we have a dashboard which tracks everything as well. It looks at all of the swings in the variations, at the different loan values across the whole portfolio at 5, 7, and 10%. And then we also look at the monthly gross rental profits. We look at where all the bottlenecks are, so where the negative numbers are. And then the biggest problem that they had, obviously, which is why they wanted to incorporate, is they'd build up this big capital gains tax bill of 1.3 million across the portfolio. That's the gross capital gain. And then we have this Section 24 problem where they're bringing in £500,000 a year of rental income, but the tax before the relief is 202,000, 40% of that number. And then the relief on the interest is 20%, which gives it 56, which means that the tax liability anyway per year is £145,000 in taxes, which means that their net profit was only £75,000 a year after they've paid all their taxes and disbursements and mortgage interest payments and stuff. So you can see like the implication that Section 24 is having on people, and this is one of the reasons why people want to incorporate their property portfolio. But at the same time, it's really important that you understand the latent gains and not to create those latent gains, and hopefully this video helps you to describe that. So hopefully that was just like a really quick overview and a summary of what we're doing with this client, and you can see the compounding effect of a latent gain if you don't understand and fix that at the outset when you're building your portfolio. So let's jump back over, and I'm going to go into the options that you have to basically solve these latent gains issues. Okay, so now we've looked at my client's portfolio and you can see the astronomical latent gain that was created. Let's look at some of the options that my client has and you might have if you've got a latent gain within your privately owned property business. Now, the first thing you can do is to move abroad and become a non-resident. And obviously I've already done that. I've moved abroad to Dubai. I'm a non-resident of the UK. I'm a full resident of the UAE. I didn't move because of incorporation, by the way, though. I moved for personal reasons. Of course, one of the main reasons was taxes, but there's also many videos on my YouTube channel which talks about why I moved to Dubai, and also that has my honest 1-year review of living in Dubai, okay? But one of the things you can do is to move abroad and become a non-resident, in which case your acquisition costs are deemed to be the value of your properties as of April 2015 or the date you purchased them if they were acquired after April 2015. So you could become a non-resident. That might solve your latent gain tax problem. However, you know, it's quite a big move for most people, and most people are settled in the UK and they just don't want to move abroad. But it's an option, it's a consideration. The second thing that you can do, and this is the most common one that we see, and it's probably my favorite one, to be honest, if you can, is to reduce your debt. And in this scenario, it would be the mortgage liability. So if we look at, let's say, for example, the first property that I showed you, where we had the debt of 225,000, but the base cost was 208,500, we just need to reduce the debt from 225,000 of the mortgage, pay the mortgage down to the base cost of 208,500, so that becomes a level playing field, so it becomes nil effectively, okay? So effectively what we're doing is we're saying that the mortgage liability is equal to the base cost, and then we can incorporate, right, without a latent gain. Now, if you have surplus cash to do that, maybe you've got, in that example, £16,500 kicking around, you could just pay that down. Yes, you might pay an early repayment charge to do so, but it's an option for you, okay? It's a consideration. It's maybe better or cheaper way than paying the tax bill. You'd have to work out the numbers to see what works best for you, but it's an option. If the tax bill's so big, like we saw in my clients' portfolios, where it's into the hundreds of thousands of pounds to reduce the mortgage debt, one of the things you could do, and sometimes our clients do this, if you have your own home with a lot of equity in, or it's unencumbered, what you could do is you could release the equity from your own home as a short-term finance method, reduce your mortgage liability in the property portfolio so that your mortgage liability comes in line with your base cost, and then incorporate. Then after incorporation, you can then refinance the property and effectively get the money back that you put in to the base cost to solve the latent gain tax problem. And you can take that money back and then pay off your own home again, okay? So that's one of the other things that you could do. There are some tax implications on doing that to try and get the money out of the limited company. And again, you'd need to do the subjective tax calculations based on your personal circumstances and the mechanisms of the way that you astutely put that money into the business so that you can take it out in the most tax efficient way. But you need independent tax advice to do that. I'm just talking to you today in a generalist way to give you information about some of the ways that you can deal with a latent gain. And one of them is to pay down and reduce your mortgage liability. One of the ways you see our clients do that is to release equity from their own home, pay it down, incorporate, after incorporation, refinance the property, take the money back to pay off the source of finance that they borrowed from. And that source of finance they borrowed from doesn't always have to be your own home. It could just be borrowing money from a friend, right? Or borrowing money from a third-party investor and paying them a bit of interest while you're borrowing the money for. Short-term finance solutions to reduce your mortgage liability debt in line with your base cost will solve your latent gain tax problem. The other thing that you can do is you can add other assets to the business so that your equity is the same level as your capital gains. So in this example, we could effectively go and buy some more properties, maybe for cash if we could, that would be the best thing to do, or a lower loan to value so that again, we're getting our base cost calculation up so that it's either higher than the mortgage liabilities across the portfolio or at least in line with the base costs, okay? The base cost is in line with the mortgage liabilities, okay? So that's another way you can add assets to the business, and sometimes we see our clients do that. Now, of course, if you're in a situation where you had this lump sum of cash, rather than adding assets to the business, it might make sense just to pay them down, but sometimes they add assets to the business and buy them for cash because, of course, it's probably cheaper if you can do that because you're spreading your base cost over multiple properties. This property is unencumbered, so you reduce that mortgage liability against the whole portfolio. You get another asset, the money's working for you, and you haven't got to worry about any early repayment charges and any additional fees that may occur in association with remortgaging and refinancing properties, which I'm sure those of you who are watching this video today are already informed property investors, or even if you're new, you understand that refinancing, remortgaging property, when you take out a loan, has fees to it. So it's a more expensive way to reduce your latent gains than if you just brought an asset for cash. Okay, so hopefully that helps you understand what latent gains are and how to deal with them. If you liked the video, please go ahead and give it a like. I'd really appreciate it. If you're new to my channel, make sure you hit the subscribe button and follow my content so that you can be updated for more regular property insights and knowledge and learning. And also, please make sure that you hit the bell icon so you can be notified of the weekly content that we release. Now, lastly, just before I go, I'm also going to create a video on my channel in the next couple of weeks that will come up here. So if it's not already here, it will be created in a couple of weeks. But if it is here, it's already been created. And I'm going to be talking about how to basically wash out your capital gains tax bill on incorporation under Section 162, where you effectively exchange the capital gain in your business for shares on the day of incorporation, providing that you haven't got a latent gain problem. I'm going to create a separate video on that, all about capital gains tax and what does actually washing out your capital gains actually mean. So go and check that out. So I hope you found this useful. Thank you so much for watching. Leave any comments, questions in the chat below, and I'll go in and answer all of your questions. If I can help answer your tax questions, I will. If I can't, I'll refer it to my tax team and we'll get those answered for you anyway. Okay, so again, like I said, thanks for watching. See you in the next one.